So, recently Sintana made this acquisition of Challenger Energy or announced it. It hasn't closed yet. And it has been controversial. Sintana shareholders, broadly the retail shareholders, based on the online messages, don't really like it. And even some Challenger shareholders have expressed discontent for it because they think they're not getting a big enough premium for this great opportunity. And Sintana shareholders think, they're overpaying for these speculative assets and it's bad timing and it's conflict of interest and etc. So I will be breaking down this whole thing and looking at the different arguments and looking at the assets Sintana is buying, what is it paying. So we will start with that. What is Sintana paying and what is it getting? Then I will look at whether there are inherent benefits to combining these companies and how do these assets fit Sintana's long-term goals, and then I will look at the timing, whether the timing is bad or good or bad, and then I will look at the shadiness. That part will be about the shadiness of the acquisition. And I thought I'll give you my take on shareholder activism for retail investors, because some of these Sintana shareholders are getting into something like that, and it's a good opportunity. And then I was making this thing. I thought I might cover some other Sintana news that recently came out as well. So that will be the ending. So this is gonna be the video. And there's gonna be timestamps below the video if you wanna go to a different part of it. So, this is the deal. Every Challenger share gets 0.4705 new Sintana shares, which will result in 126.7 million new Sintana shares. And this will result in these Challenger shareholders owning 25% of the combined company. And the premium they paid was basically 100% based on the 3-month and 6-month average price, and based on the Sintana share price when it was announced, the acquisition. The Challenger share price ran up to the acquisition, and we will cover that in the shadiness section. But basically, when they were negotiating this, they were thinking about 100% premium, and they're gonna vote on this. So this is the dilution amount. Is going from here to here, and this is the dilution. And based on the Sintana's price of 66 CAD, when it was announced, basically, the USD valuation of Challenger would have been about 60 million, based on the Sintana price. But because it's a ratio of Sintana shares, it goes down with the Sintana. Like the current Sintana share price is 51 cents Canadian. Now Challenger would be this much. So the stock went down after it was announced because people didn't really like it enough. And then there is the arbitrage that was with Challenger. So that kind of started closing with the Sintana stock going down. So if this goes through, if this gets voted through, this would be the fully diluted market cap of Sintana at this current Sintana price, 183.9 million USD, which I think is great value for this for the combined company. Will it go through? So they need 75% of votes cast at the meeting of challenger shareholders. So, but it's just of votes cast at the general meeting. So, I think it goes through, because even though there were some retailers unhappy about it on challenger side, I don't think these people are gonna vote. Like, retail shareholders don't vote at these things generally, and so they don't count if they don't vote. And all of these people who support this acquisition, who are these big shareholders, they will vote. So, and they already have 34.2% that are said they're gonna vote yes on it of all the shares. And I would guess Challenger has consulted these large shareholders here. And they have a lot of institutional shareholding, so, you know, if they're gonna do and make this deal and it's gonna come up to a vote, I would guess they have these people supportive as well. And because they're large shareholders, they would vote. So I think it goes through. I think it's very likely to go through because of these factors. So now that it is very likely going through, let's see what we are getting. I mean Sintana shareholders. I am a Sintana shareholder, and I didn't know about Challenger before, so that's my perspective. That's the perspective of this video. So the balance sheet impact. Challenger got some cash here coming from this asset sale, 1.75 million, and they have 6.6 million cash and 0.7 restricted cash, and they expect to be well into 2027 if that was just Challenger to be capitalized. But you know, the combined cash here would be this much, around 9, and then they have other short-term assets, 2.2 million of payables, so that would be 7.7 million USD positive impact on the, you know, on the cash type of short-term assets type of situation. And the Charlestown, which is the conflicted party here, they are gonna provide working capital facility of $4 million from the closing of the acquisition. So there's that. So end of Q2, Sintana had 11.2 million of cash, and if we combine this and the cash from Challenger, we would get this much liquidity. So the combined entity will have a nice amount of liquidity. And one benefit I would say here is that without this acquisition, Sintana would have likely raised money in next year if they didn't do asset sales, because they have to pay 2 million of this Corcel acquisition. They paid 500k. They're gonna have to pay 2 million when it closes. They burn about $1 million a month, so by the end of the year we are gonna be at 7.2. And now if for example Pell 90, if there is a well, that's gonna cost about 5 million for Sintana, because they don't have a carry on that anymore. I mean, that would just put them in a raise situation, and you know, even without that, you know, if they're gonna do anything, they would have a low cash situation. So they would probably raise next year without this and dilute in that way. And before we jump into the corporate presentation, I'm gonna go through the assets they have in a very kind of basic way, like numbers way. So they have 2 assets in Uruguay. I mean, they have something in Bahamas, but that's not going anywhere. and they are selling their assets in Trinidad and Tobago. So they have two assets that matter in Uruguay. So they have this one, which is they have 40% with a farm out, and Chevron is carrying 35 million in cost if it proceeds with seismic and drilling. So they're gonna fully carry them through the seismic, which is basically 15 million is would be their share of the cost. So they're gonna fully carry their share of the cost inside seismic, and they're gonna carry 50% of the drilling cost of the first well, which they think would be 20 million that they would be carrying for Challenger or Sintana in the future. They're seeking a permit for the seismic work and expect to receive the permit and start it in late this year. And this asset has it's pre-drill, so these are just the estimated recoverable resources based on some 2D work and all kinds of stuff they do. They make an estimated resource. So the mean estimate, so the average of all the different estimates was 2 billion barrels, and the upside case is almost 5 billion barrels. So obviously this would be big if they could find this much. So they have another asset, and they have 100% of this also in Uruguay, and they are seeking a farm out for it in Q1 26. So they did this technical work program, and now they are ready to do the farm out, and they are trying to get suitable partner or partners during the first quarter of 2026. And this one has a lower estimated resource of mean of 380 million of recoverable, and upside case of almost 1 billion. But this is a shallower water. This is shallower water, so it's lower cost, and so they think 100 million would be recoverable, would be commercial in here, which would be quite a bit lower than the mean estimate. Okay, so let's look at this. Let's look at this. Now this is the real thing. Put this one away here. Okay. So this is the whole idea of this Uruguay, this country. So Africa and South America used to be together like this, and then they were separated. They, went away like that. And basically the assets in Uruguay, they are in the same place as the Orange Basin would be, when they were together like this. So the idea here is that they have the same geology, that you can be regionally correlated seismically and and so basically the idea is that this Uruguay side is basically the Orange Basin in the other side of the Atlantic, like this. It's similar thing here, because they used to be together like this. And here is Orange Basin. Here are the discoveries in the red, and here is Uruguay, and here are the prospects on the yellow. So that's and basically when all of these Orange Basin discoveries were made, all of these companies picked up the blocks from Uruguay. So these are all blocks that were available, and they are all in the hands of companies now after. And none of these were being explored before, but after the Orange Basin discoveries were made, these companies picked up these blocks because of this whole idea. And Challenger was first in OFF 1 here, and then obviously a junior company can move faster, so the majors came after. So here is Shell, UPF, Argentinian National Oil Company, and Apache is a big oil company in America. And then they picked up also of3. So that is that. And now Challenger is the third biggest acreage in that sector. And basically it was, and Sintana will be, the only way to really get exposure to this play. Because, I mean, these are all big companies, so even if they make a discovery here, it doesn't affect their share price that much. So Challenger and Sintana in the future, assumingly, will be the only way to play this orange basin on the other side. And also, so these are the commitments. Yeah. So because Challenger was first, they got this with a very low commitment, this of 1. So they got this with only 2 million of their commitment. And now Chevron farmed in, and now they have this much of commitment. And these other companies, they had to make a larger commitment here, 10 million, 125 million, 10 million, 40 million, 10 million. And then Challenger got this one last, area of 3, with a lower commitment. I guess area of 3 was kind of a least wanted block here, but yeah. So, but anyway, they got this with the lowest work commitment, and now all of this activity is happening. But the drilling is basically expected maybe late 26, probably 2027 is when there's going to be drilling here. So this is kind of an earlier stage situation, but as they say, it has been somewhat de-risked by the Orange Basin discoveries. They de-risked the geology and stuff. And there are more stuff here. So what should I show? So here the of 3. Now this is kind of unstructured now, my presentation. Anyway, so here are of 3 prospects here, and they have a little bit lower water depth here than the of 1. And here is the financial breakdown. Yes, they also got 12.5 million of cash upfront on top of the 35 million work commitment. So they got this one with almost 50 million of total payments and funding to Challenger or Sintana in the future. So here are the area of 1 prospects, which are a bit deeper, although this one is shallower. But the reservoir depth is deeper here. So the reservoir depth is deeper here significantly. So it's a bit more expensive, but the prospects are also bigger here. Okay. So here is our timeline, and we'll get back to that. And this was also something that people were talking about, the jurisdiction. I've heard people say, oh, it's a socialist Latin American country. That's not the case with Uruguay. And if you're talking about the jurisdiction risk, and we are in Sintana, Uruguay has lower jurisdiction risk than Sintana. They have a better policy. They have the production sharing contracts for 30 years, possible for 10-year extension. They don't have royalties. they have lower taxes for oil production. They have the Namcor takes a fully free carry, and the Uruguay National Oil Company takes, they participate in operating costs, and the company can get their capex back from future production. So it's it's definitely a better country than Namibia in every way. Basically, it's the after Guyana, because of their Guyana is the highest GDP per capita because of their oil discoveries, but after that Uruguay is the highest GDP per capita Latin American country, basically the best in Latin America in almost every metric and stuff, and it is a better jurisdiction than Namibia. So this doesn't add jurisdictional risk, definitely it doesn't, considering that Sintana is in Namibia. So that was kind of the short look at the assets. So I would say it's a pretty, of course, if they could find these amounts that they are the average estimates, it would be pretty huge. But obviously it's gonna take a while before they are actually drilled. But honest, like the price and the assets, I see it as a pretty good deal. And if like an asymmetric bet, and if like this vote didn't go through, I didn't know about Challenger, but if this vote didn't go through, Challenger stock would drop most likely. I think I would buy that stock. I didn't know, but I've said that many times, but I think I would buy that stock. I think it would be a similar level of risk reward to like Bank Continental, and so I think just the assets. I think the assets are very interesting, and the story here. Now, what about the benefits of the combination itself? How does it fit long-term plan of Sintana? I do think it fits the story very well, because basically they are now the story is basically that they are the Orange Basin play on the both sides, and they are the only one on the Uruguayan side to get exposure to that, and they remain to be the best play in Namibian side. If you look at the competition, basically you have Africa Oil, which has Venus and 3B4B, but their valuation is mostly based on Nigeria. You have Echo, who has they have only one asset in Orange Basin, they have a couple in Valvis, and that's very early stage. Bank Continental has only one asset, and Oregon has some very early stage assets. So basically Sintana is already the best way to play the Orange Basin trend, or the idea that is going to be the next big oil development hub, and this fits to that story. Now there's some basic synergies like save some costs. The Sintana was saying it's diversification, but I wouldn't call diversification as like just a benefit by itself. But when you combine two companies, you combine the corporate, the IR and stuff, and you save some costs. That way, the costs are lower than it would be if those were two companies. Now they also have, they will get more liquidity from this, so now we can avoid the race, and we can better direct capital into the winning assets. Sintana, they have this portfolio of different assets, and they don't need to direct capital to their current winning assets, which is PEL 83, but for example, if they make a discovery in PEL 90 and they want to keep their share there, they would need significant capital here, or keep their share in Uruguay in Off1. So now they can do that better, and they have easier to raise capital. It's a bigger company. So, and if they cash out of one of their Namibian assets, now they have, like if they would cash out of Bell 83 right now, they would be just this company with a huge amount of cash and nothing to put it towards. And that situation, we would guess it would be a big discount from the market to the the valuation would be lower because they would just have a bunch of cash and nothing to put it. Now they have these Uruguayan assets and they can direct capital to it with high working interest. Because currently Sintana has just like bunch of these assets with 5%, 7%, stuff like this. And so now they have actually assets with significant working interest. But I would say like the benefits of the combination, it's nothing like it's nothing amazing here. It's, I would say, generally positive effects from the combination, but it's nothing like some tech company buy some other tech company to integrate their product to become way better product. Like it's nothing like that. It's nothing like a huge synergy. But I think it's generally it fits their story and stuff like this. So it's I think this is generally there is benefits to the combination. Now the timing, this is the controversial one. Is it a bad timing or a good timing? So let's just look at the timelines. Let's just look at the timelines of what each company is expecting, because obviously if something happens that takes Sintana share price up right after this acquisition, it looks bad for Sintana, the timing. But if something happens that would have taken Challenger share price way up after the acquisition, then the acquisition looks really good. So the big catalyst here on the short term are basically this Pell 83 farm out. And Gallup has, like just a week ago or something, when they had a earnings call, they reiterated that they think they're gonna close the farm out of Pell 83 by the end of the year. And this would basically cause that, and they have said many times that they're gonna look for a major that will fast track that. So that will be big. If that happens by the end of the year, that will be big, because Sintana has that carried, and if there's gonna be a major that's gonna fast track the development, there's just gonna be a lot of drilling, a lot of stuff going on there, and a lot of value being generated for Sintana. So that's the big catalyst that Sintana is expecting, and it's the major reason why people say this is a bad timing for this acquisition, because this is gonna happen. I would say it's not for certain, like this thing has been delayed before, but because what we've seen leaks from Petrobras and others talking about bidding for this, and now they are reiterating the timeline with just 2 months left on the year. I would say this is starting to look pretty likely that this is going to happen by the end of the year. Now what does Challenger have going on? Well, they should get the 3D permit and start that, which would be good, because it shows that, okay, well, now Chevron is starting to spend money on behalf of Challenger, and it would, and this thing is moving forward. The bigger catalyst would be this farm out here. They're expecting it on Q1 2026. So if both of these catalysts happen, I think it's gonna look like a good timing, because based on the market cap of Challenger, or the purchase price, that stock would have gone up a decent amount from that farm out. So, but this is a junior company that's saying, hey, we're gonna do a farm out at this time, and I've seen that story. You know, these things tend to get delayed, they don't, I would say they have less of a likelihood of getting that thing closed in Q1 than Gallup has at getting their thing closed by the end of the year. So based on that, I would say this is pretty likely, this 3D acquisition, permit and starting. I would say that's pretty likely, but that's not as big of an catalyst than the Pell 83. And I think this off-the farm out, it's less likely to happen than the Pell 83. So based on that, I'd say the timing is most likely, it's most likely poor timing in that way. But we'll see. Obviously, they have been working on this for a while, so I mean, if they have been working on this acquisition for a year or something, or even 2 years, because I mean, we'll go into that later, why they would have been working on this for a while. You know, you're gonna have to close it sometimes, so it's so it can get complex in that way. But yes, the timing is probably it's a bad time. Now the shadiness aspect. So the first would be this, this would be the first shady part. Now look at this. This is when the acquisition was announced here, and then the stock goes up. But the stock just had this unexplained move, you know, nearing the announcement. And it was actually unexplained, because there was like an update around here or something. And it was good, but the market already had time to react to that. So I would say that couldn't explain this. So, and I even went to look at what were people saying, what were Challenger shareholders saying about this. And they're dumbfounded as well, and they're thinking what's going on, there must be another farming, or maybe it's a takeover. You know, still people are thinking about what's going on behind the scenes. Is it a takeover? Maybe it's a takeover. Yeah, somebody's saying too many, so I think takeover is unlikely. Well, it happened, I guess. But basically, you know, what could this be? What could this be? I mean, the most likely scenario seems to be that somebody leaked it. That somebody probably leaked it, and you know, there was something going on. Of course, this is speculation. This is not an accusation, but I mean, what could it be? What could it be other than that? So that's kind of shady. But other thing is this conflict of interest, as they say. So the CEO of Sintana had a board seat and options in, you know, Challenger, and Charlestown, which is a private equity company, which is Robert Bose is also involved, which holds shares in Sintana. They had a big position in Challenger. So there's obviously they benefit disproportionately from this. So obviously the argument is that this is good for the shareholders, but of course they benefit more than others. So there's gonna be a question of conflict of interest, and there was this whole thing that they did a meeting that he was excluded from, and said he was good and stuff, and approved the acquisition. The proposed acquisition was recommended to the board, and it remained unanimous approval from the voting directors, which did not include Robert, who was recused from voting due to various conflicts. So they said this, but this didn't quell. Is that the right word? Quell the wrath of the shareholders. A lot of people are like, look, it's not. Robert Bose has so much influence. It's not like they could have an independent view without him. But let's think about this. I'm admitting. Let's establish that they are benefiting disproportionately, and it's in that way it's self-serving. But did these other Sintanas, like other people who have influence in Sintana, did they really are they really just purely influenced by Bose? Well, actually, let's look at this first. So Charlestown and Bose got involved in Challenger in April 2024, and Challenger had a share consolidation. So based on this share consolidation, this was about 7 pence. The share price was about 7 pence. So it was close to what the share price of Challenger was around this year. It was hanging around at 8.5 this year. So it hasn't moved up much since then. And Bose and Charlestown, but at the time Bose and Charlestown got in at 8.4 pence, which was around this year's average price with the loan. And Bose joined the board. So I guess the question is, why didn't Sintana get into it then? Obviously, of 3, farm out wasn't closed at the time yet, so maybe it would have been a harder sell. And but that's a valid question. Of course, the share price wasn't much lower, so Sintana would have likely had to still offer like 100% premium for it. And so, instead of offering an equivalent of 16 pence that they did last time, now they would be offering equivalent of like 14 pence. Wouldn't have been a big difference in that way, and maybe Bose and Charlestown needed to get inside to convince them or something, to infiltrate. So anyway, but the question is, okay, so the question is, was this acquisition really supported by all these independent people who didn't have a stake in Challenger, who have a stake in Sintana? So here we see the big shareholders of Sintana. We have Charlestown, who has a stake in Challenger, and then we have Bose here, who has a stake in Challenger, and Bose has a stake in Charlestown, but we don't know exactly how much. We would guess a decent amount. So as we can see, they're not like holding a massive amount of Sintana. I mean, and from what I could find, like most of the board and management were involved with Sintana before Bose. You know, like this, like people who were founding members and stuff. And Bose got a board seat in 2019, was promoted to president in 2021, and promoted it to CEO in 2024, right? And this is the biggest shareholder, is Knowledge Katti. And he's a Namibian millionaire, politically connected Namibian millionaire. Here is some like news stories about him. Close ties to President Keiko. Worth US 100 million according to Forbes management. And he is basically who started this Namibian oil exploration. And Sintana bought their Namibian assets from him. So, and now he has a board seat. So I would say this is certainly an independent director, if nobody else, and has certainly a lot of influence in Sintana, with this largest shareholder, being the largest shareholder, and being the guy in Namibia who has all these connections, and and owning half of Custers. So Sintana owns half of this Custers Energy that owns the Namibian assets like Peleti. Katti owns half of that. So I would say in many ways he's probably more influential than Bose. I mean, in some ways. And he supports this acquisition while we are happy with the Uruguay transaction. And obviously he's all about Namibia. But he supports it. And we don't, according to what we know, he doesn't have any stake in Challenger, nor these other people who were there before Bose. At least what we know. Of course, we don't know what's happening behind the scenes, who is talking to friends and family, but I'm not making any accusations or speculations about that. Based on what we know, only Charlestown and Bose had disproportionate benefit from acquiring Challenger that the other shareholders don't have. But like what I can see, like I think they were able to actually convince the board and the other people in Sintana that it is a good acquisition for Sintana, not just for them. And I don't think, like some people said that the rest of the board and management are living in fear of Bose, as based on the fact that they are not Bose's guys. They promoted Bose later, and they were there before Bose, most of them, and that he is not even the biggest shareholder and stuff. But and also with the Bose and Charlestown situation, I would also want to defend them a bit, because if you look at Sintana here, their history, they were this failing company they had this project in Colombia, or I think Colombia, and Charlestown made an investment here, and then here in 2021 they made this transformational investment in Namibia. And I would say Charlestown was basically what made this possible. They obviously got involved. They funded they did the private placement that funded the acquisition, was from Charlestown, and after Bose became the president, in 2021, I mean the stock has, even now with the recent poor performance, the stock has done very well, and since he became even since he became CEO here, he has done decently well. And the other acquisitions that Bose has done, they have been received well by the market and the investors. Now this is the first one they don't like. So I would say that also, but you know it is somewhat shady, the acquisition, from the looking at the share price action in Challenger, and obviously there is a conflict of interest. So now, after we are looked at these four categories here, the assets and the price, I think they are fair. The combination of the companies, does it benefit? Is it a good combination? I would say it is. The timing, is it good? Probably not. And the shadiness, is it shady? It is somewhat shady, but it's not too shady for me. And so now I wanted to talk about this next topic, and it's about, because I have seen a lot of these people in discussion forums and talking about who don't like this acquisition, who are in Sintana. They're talking about, I'm going to contact a lawyer. I'm contacting a lawyer. We are organizing and doing something and talking to IR. We are trying to stop this acquisition. Basically doing a form of shareholder activism as retail investors. And this is kind of a general view I have developed. So it's not just for this situation, but this situation gives a good opportunity to talk about it. So I do not think retail investors should get involved with shareholder activism. I mean, just if you are type of investor who is just looking to make money, I think it's not worth the squeeze. The juice is not worth the squeeze. It's not worth the time. And this is the argument. So activism only makes sense for large shareholders who have influence, cannot easily sell their positions, and are stuck with the management. So I mean, that's retail investors have no influence, at least alone, and they can easily sell their positions, and so in that way they are not stuck with the management. Like if you are a big firm, if you not own 20% of the company and the management is mismanaging the company, then you're kind of stuck in that position. You cannot just sell 20% of the company easily. So it makes sense, and you have actually a lot of influence with your position and the connections you most likely have. So you actually have influence to make things happen, and you can sell. So it makes sense, Carl Icahn type of situation. Like you can't find the Carl Icahn of retail investors. You can't, tell me which retail investor is out there being a shareholder activist and making a difference and making money. Like you can't find one because it just doesn't make sense for retail investors. So basically, yeah, that's it. So it's just gonna be a big time sink if you get involved in it, and that could be spent on researching other companies, so just selling that company that you don't like, because you're most likely not going to be able to change it, and move on, unlike these institutionals who may have to be activist shareholders. Now, but let's say you actually can make some waves, like you actually can get some publicity with shareholder activism. Maybe send a public letter or something. Or can get other retailers to band with you like in a gang of retail shareholders against the management. The effect might actually be not desirable, because it creates uncertainty, and that creates fear, and that creates selling, and that creates the stock going down. And what do we really want in investing? All we want is that the stock goes up. Like that's really the final goal of investing. Unless you're shorting, then it's stock. But that's what we really care about. So it could, if you actually succeed partially but not totally, then the most likely outcome would be something like this: uncertainty, fear, selling, stock goes down. So there's that. Now there's also that you might be wrong. That's also a possibility. But this is the biggest one. This is the biggest problem with shareholder activism for retail investors. I even said it here. Most important. So getting involved creates an emotional connection with the stock and the position you have taken, and affects your ability to make rational buying and selling decisions. So if you go activist, you're now kind of stuck with your whole stick. You're kind of in the battle. You have taken a position, and you're in the battle for the future of the company. And now you're not just looking at it objectively, just okay, so is this the best investment I can make right now? Is this the best risk reward I can make right now? You're in this fight for the company, and it will affect your ability to make rational buying and selling decisions. So I would say this is the biggest problem with getting involved, with trying to change what the company is doing, So based on all of that, like it's just not worth it. And it's usually like because people have this, people want justice. Like if the management is being self-serving or shady or something, there's like, we want justice, we want transparency and stuff like that. So, but it's really like, especially if you're in stocks like Sintana, like microcaps listed in Canada, like this is not the place to find justice. Like this is the wrong place for that. Like this is the ghetto of the stock market. Like TSXV. Like this is a place where you have like a gold exploration company, and then uranium price goes up, and they rebrand to a uranium company, and then they rebrand to a cannabis company. And then the CEO is in the discussion forums online with a fake name, and the company is paying YouTubers options, and like this is like it's the jungle, and there is it's just what it is in this space of microcaps. The management is always like, the CEO is always involved in 3 different companies at least, and so these situations where something like this happens, they're not uncommon. Just early this year, Serrado made this acquisition, where the CEO was also the CEO of this small company that they bought, and I didn't like that acquisition, but I thought that was a poor risk-reward acquisition, much worse than this Sintana one. And I sold the stock after that, but then I bought the stock back, and it did very well because of other assets they had. So but I was dispassionate about it, and I didn't like the acquisition. I sold the stock. Then there was other developments I bought back in. Now I'm holding it despite the acquisition, and now the gold price is going up so much. That acquisition might end up being good, but I still hold that it was a bad risk reward at the time. But anyway, so that's kind of my take on that. You just have to stay practical, and I would not recommend getting into like trying to change what the company is doing. Like, it's just not worth the time. Now, so let's just so Challenger acquisition. It's probably bad timing, as I said. It's somewhat shady, and but I would say it's. I like many aspects of it. I like the assets. I like the how it adds to the story, and long term it will, I think, will most likely end up being a positive thing. That's my take on that. Now let's look at some of these other recent news. I was just thinking, like I might as well just look at this now. I'm in this video. I'm in this video right now. So, Corcel receives a permit for seismic acquisition exploration drill at Con 16. So, Sintana has 5% on this one, plus 2.5% net profits interest, and up to 50 million, and then 1.5%. I think that this was a very, very good acquisition, like based on the potential and the price they paid, which was very, very low. And now this got a permit, and we could get a drill here, maybe next year possibly. So that's good. That's good news. Not huge news, but good news. Now this one, this is of course Bell 83 here, and this BV kind of took, annoyingly, look at how they sliced our block and made it like not geometric. You see how all these blocks are like rectangle, like square type, and they just did this. Like, how can you do that? Like, how can you just do that? And this should be ours. This should be a line here, a straight line here, and this should be ours. But anyway, they made good results. They had a good results here, or preliminary results are encouraging. So at this Karas 1, early results indicate that it may contain hydrocarbons wetter than dry gas, which basically means oil or condensate. And they're gonna do follow-up appraisal campaign. The well was strategically designed to interact several targets. Anyway, so it provided valuable geological data across the broader petroleum system. So if there is a system, if there is a petroleum system here, it's most likely gonna reach our block in Bell 83. And as we can see, we don't even have prospects here. Like, here are prospects, here are discoveries. So this could open a whole new area here. And of course, everything that is here is good for Sintana, because all the development is carried. So this is good news, not huge, but and here we have this Bell 87. Obviously, Sintana has 7.3% here, carried to development, and they find some new prospects here, and they upgraded the prospective resource a decent amount. So this is the old prospective resource, and this is the new. So look how much bigger it is. And I saw the stock was still doing badly. I thought, I got some at 8 cents, or is it 0.08 or something, whatever, 8 in Pan Continental. I think that's the price I like it at. 9 cents, no, 8 cents. That's where it's asymmetric. So I think Pan Continental is quite asymmetric. I don't know if I think I'm misusing that word a bit, but I'm gonna use it anyway. I think it's asymmetric at 8 cents. I got some there. And they're obviously the operator here with the very was less diversified than Sintana, and Sintana obviously has. So this is good news here. The problem with PEL 87 is just that the farm out is just constantly getting delayed. Like Sintana had in presentation in like May, they had in presentation that they were gonna get farm out in there in summer, and now it's closing in on Christmas, and Pan Continental still is very they're just saying the parties are in data room, looking at it. So it might take a while for this farm out, but I think it's basically inevitable that it will happen at some point. I mean, this it's the biggest prospective resource in the the biggest prospective resource in the undrilled sections of Orange Basin, and it's the only one like that's not in the hands of a major, like only big prospect that's not in the hands of a major in the Orange Basin. So I think this is going to be picked up eventually, and it's going to be a big deal for Pan Continental especially, and of course Sintana as well. Then we have PEL 82, which is in the Valvis Basin. Sintana has 5% carried, and Chevron is 6 approval to drill 10 offshore wells in there. The proposed program covers blocks this and this, and these two blocks are PEL 82. So 10 offshore wells would be pretty big. And Sintana's website says that Chevron is currently evaluating and is planning to initiate an exploration drilling program as early as Q1 2026. So this would be pretty good if this happens. I don't think people are really expecting this. I don't know if I'm even expecting this to happen at this price, this time, but it could happen. Yeah. And the carry here, they still haven't told how significant is the carry, but we would assume it's at least one well. At least it has to be at least one well, because otherwise it wouldn't be carried if the next step is one well, and they're saying it's carried. So that's the video. That's my video. Subscribe to Almost Mongolian and check out my Seeking Alpha advertisement, and then sign up to Seeking Alpha. Seeking Alpha Premium is the only Almost Mongolian approved paid investment research service. Friteups on stocks. Comment sections. Detailed financials with the ability to change currencies. Valuations. Dividend history. Earnings estimates. Compare pairs. Easily accessible SEC fillings. Earnings call transcripts. Nevs. Stockscreener. I choose Argentina. Market data. Get $30 off with my affiliate link. It's only $269 for the first year. It's nothing. There is also 7-day free trial.